Hey guys, it's Jeffrey. Airbnb stock is going to be worth $240 by the end of 2025. In this video, I'm going to go over my first impressions of Airbnb stock and why I think it's going to 4x by the end of 2025. If you follow my channel, you know that I have a healthy position in Tesla stock. I did an analysis of Tesla. You could check it out over here. Now, Airbnb is no Tesla, but there's a lot of things that I like about Airbnb, the company. I broke it down into three categories. One is their increasing demand. Number two is their newfound philosophy in cost cutting. And then number three is their executive team, especially their founders. So let's talk about demand. Demand is down right now because of the global pandemic. People are not getting on airplanes, they're not traveling overseas, they're not even traveling from state to state. Business is not going to return to normal levels until we get a vaccine and it becomes widely available. But when we do get a vaccine and it does become widely available, business for Airbnb is going to come back fast. Just think about all the pent-up demand. Think about all the people who have planned trips and delayed them, but who are also intending to rebook their trip after the vaccine comes out. Think about people that have delayed their weddings. People have to fly away from faraway places in order to attend weddings. Think about people who haven't seen grandma or mom for over a year. Not only do I think the number of bookings will go up, but I think the price will also have to come up because there won't be enough supply to fulfill the demand. So if you are just a traveler and you intend to book an Airbnb, let's say after April, I think you should probably book right now before prices go up. But even during the pandemic, the demand for Airbnbs have been really resilient because I think people are realizing that Airbnbs can be safer compared to hotels when it comes to being more private and being better for social distancing. You can book an entire back house, or you can even book an entire lot where you and your family would have exclusive access to an entire property. Where you compare this to hotels, you have to go into crowded hotel lobbies, you'll have to share elevators, and even share ventilation. So as a result, I think when we look back, we might see COVID as a net positive for Airbnb because adoption rates have gone up as a result of COVID. But even a couple years from now, after we've all forgotten about the pandemic, adoption rate for Airbnb is going to increase over time. And a lot of this is going to be due to just underlying travel trends. People are traveling outside of major cities where there are less crowds, but also less hotels, meaning there's going to be an increasing demand for Airbnbs in those areas. People are also traveling within their country or within their state. And we know that when people do that, they're more likely to use Airbnb. Also, with this new work from home movement, it means that it's also a work from any home movement because you can work from anywhere as long as you're within the correct time zone. There's already a group of people who do this. They live a month here, they'll live 3 months over there or 6 months over there. And this group of people is going to increase over time. There's just also a ton of room to grow. According to Airbnb in 2019, they accounted for less than 4% of the overall domestic and international stays that year. I can easily see that number going to 10 to 20% in the coming years, and maybe even 30 to 40% long term. One of the things that I don't like about Airbnb is how much they spend on their expenses, especially in their product development and sales and marketing. But another reason why we might look back and see COVID as a net positive for Airbnb is that COVID really forced them to look at their expenses and analyze what they thought is going to make their business successful and what they thought they were wasting their money on. Brian Chesky, the CEO of Airbnb, recently admitted that they were unfocused. They thought they could do a bunch of things at the same time, but COVID brought some clarity to their situation and they will now be focused on the roots of Airbnb, which they think is building a sense of community through quality hosting. So no more investments in their airline booking site, no more investments in some of the businesses that they acquired like Hotel Tonight, in business travel support, in professional project management software. and no more investments in their premium and luxury lines like Airbnb Plus and Airbnb Lux. This means they're going to spend less on product development, and this expense is going to remain low in relation to their gross profit. Another expense that COVID really brought attention to is their marketing spend. I think that they realized that they were spending way too much money on marketing. So what happened was that when the pandemic started to heat up and when the economy started to slow down, Airbnb stopped all marketing spend. And they were surprised to see that business returned back to 2019 levels starting in late May and early June. This is what Brian Chesky said, and I wasn't really able to verify this through looking at their financials. But I think what he was trying to say was that he was looking at the number of nights booked, and he was saying that the number of nights booked now is similar to this time 2019, but the prices per night on average is lower, which is why business has not really returned to normal yet. There was a news story going around back in July where Airbnb said that on July 8th, their guests booked over 1 million nights, which was at a level that they haven't seen since March 8th. And this is quite an amazing achievement considering that they did this with almost zero advertisement. So based on Brian Chesky's remarks and based on the number of nights that they're able to book without advertisement, I think that their sales and marketing expense is going to remain low in the future, which is going to be very good for their profitability. It's really important that Airbnb keep their costs under control, and hopefully this is not going to be a problem in the future. They've already pretty much have a presence in every country except for the really dangerous ones like North Korea, Syria, Iran. So it's reasonable to think that their expenses are highest when they are trying to penetrate into a new market. But since they've already gone through all the hurdles of getting into each market, it's pretty reasonable to assume that their expenses are not going to increase as rapidly anymore. Let's talk about the founders who were all still part of the executive team. Brian Chesky, Joe Gebbia, and Nathan Pacharczyk. I really like them. They all have a very high work ethic, and they all have different strengths that play really well together. Brian Chesky, who is their CEO, is their leader. He's very likable. He has the ability to lead and inspire. He says that his main strength is his ability to learn. He's good at getting good at things, which basically means that he knows a lot about a lot. He might not have the depth in any one subject that someone who is an expert at that subject might have, but that's okay for a CEO. Joe Gebbia, who is the chief product manager, I would say is the most entrepreneurial out of the three. He is really good at sales and marketing, and he is also a really good storyteller. There's a really good interview with Joe by Tim Ferriss where Joe has a lot of interesting and entertaining stories about his accomplishments in design school. It's a really good interview if you want to get a better idea of the type of person that Joe Gebbia is. And you can just find this on YouTube by searching Tim Ferriss, Joe Gebbia. Nathan Pacharczyk, who is their chief strategic officer, he is an engineer, so he's the rational one. He was the first CTO, chief technology officer, and it's good to have him as part of the founding team because it takes an engineer to know if another engineer is good. So as long as he's around and still in the executive team, I'm confident that the CTO role will continue to be in good hands. The combination of leadership, salesmanship, and engineering makes this leadership team, this executive team, really strong. One of the things that made Steve Jobs a really great CEO was he was basically the intersection between these three things: leadership, salesmanship, and engineering. So basically, these three founders really have the same qualities and attributes as Steve Jobs, but broken up into three people. So how did I get my $240 prediction by the end of 2025? Let's look at the numbers. So this is their consolidated income statement from their IPO filing. Let's take a look at their gross profit to see how profitable they are before expenses. You just take the revenue minus cost of revenue, and you can just see, just at first glance, how profitable they are. If you do the math, their gross profit remained steady at 75%, even up to their most current period. This is a really healthy gross profit. And the reason why they are not profitable overall is because of their other expenses. If they wanted to become profitable today, they could even do so by just reducing their expenses. Some of their expenses would be hard to reduce, like operation and support, general and administrative. But if they wanted to just massively reduce their product development and sales and marketing, they can actually become massively profitable if they wanted to. When we look at their growth rate, we can see that from 2017 to 2018, they increased revenue by 43%. And from 2018 to 2019, they increased their revenue by 32%. We're going to see a decrease in revenue for the end of 2020, but 2021, we're going to probably see revenue in excess of 2019 levels. So like I mentioned earlier, they spent a lot less money on sales and marketing this year compared to last year. This year, they spent $545 million on sales and marketing. Compared to this to last year, they spent about $1.2 billion on sales and marketing. This makes sense. They basically spent 1/4 of money on sales and marketing, and then they stopped sales and marketing ever since. So I don't expect this number to go much higher by the end of the year. So what I'd like to see is I want to see the revenue grow in 2021 from their 2019 levels. I'd like to see it, let's say, near $6 billion. And then I want to see their sales and marketing spend stay below 2019 levels. It'd be nice if it would be less than $1.5 billion. If I see those two things happening, then I would become more bullish and more certain about Airbnb's future. When you take a look at their balance sheet, they have a total current asset of $7.2 billion. When you compare this to their current total liabilities of $4.4 billion, they are doing just fine in terms of financial stability. During their IPO, they're expected to raise about $3 billion. So after their IPO, they'll be even at a better financial standing. All right, so I created this spreadsheet just to show the rough math of how I got to my 240 price target by the end of 2025. It just shows the rough math of what I think their gross profit will be and what I think their operating expenses will be. For the gross profit, I predict that they'll be able to grow gross profit at a 25% compounded annual growth rate. Some years will be higher, some years will be lower. And then when I look at the operating expenses, I believe their operating expenses will grow by only 14% compounded annual growth rate. So the reason why they will be profitable is because they have something called operating leverage. They are going to grow their gross profit faster than they grow their operating expenses. So if you take these two numbers, the gross profit of $10.9 billion, subtract the operating expenses of $6.5 billion, you get an operating income of $4.4 billion. Minus interest and taxes, you get a net income of $3.7 billion. So if you apply a 40x price to earnings ratio, this would put the implied price per share at about $240. When you compare this to other large, fast-growing tech companies like Facebook, Amazon, Apple, Netflix, or Google, Airbnb would trade at the low end of PE ratios compared to these companies. Another metric that other people look at is the price to earnings to growth ratio, or the PEG ratio, where you take the price to earnings ratio and you divide it by their growth rate. Assuming a 24% growth rate, Airbnb would trade at a 1.7 PEG ratio. I would say a 1.5x PEG ratio would be considered about fair value, but it's reasonable to think that Airbnb will command a higher multiple in terms of the PEG ratio because they will be considered a large, high-growth, high-tech company. So there's even a chance that their PEG ratio would be 2 or 2.5, which would put them at over $300 price per share. So I'm recording this on December 9th. Airbnb will IPO tomorrow, December 10th, and the estimated price will be at about $60. I'm not sure if I'll be able to get the shares at $60, but Regardless, I'm going to be buying a healthy amount of Airbnb stock tomorrow because the growth rate, even from $65, $70, is going to be pretty lucrative from now until 2025. So let me know what you think about my analysis, whether you agree or disagree. I'm happy to have the conversation. I'll be following this stock closely, and I plan to be doing a video on Airbnb stock every couple of months or so. So subscribe and like this video if you want to see more content like that. Otherwise, thanks for watching, and I will see you in the next video.